Okay, let's unpack this. We are diving into one of the most fundamental concepts in finance, the market trend. It's this perceived tendency of financial markets to, move in a particular direction over time. What defines this powerful, sweeping movement? And how exactly do analysts categorize these trajectories?
That really is the core question, isn't it? I mean, for anyone who wants to move beyond just, watching the ticker
Right.
and actually start navigating the markets, a market trend is. It's just that. It's the long arc of price action, the direction of travel, but sustained over a real period. It gives you the context for every single decision.
And we're not just talking about the day-to-day noise here, the little blips on the screen.
Not at all. We're looking to understand the huge multi-year shifts that, really define economic history. These are like the tectonic plates moving beneath the daily volatility.
Okay, so how do we make sense of it all?
Well, structure is everything. Analysts classify these trends into three sort of nested layers based on how long they last.
3 layers.
You have the secular trend, which can operate over decades. Then you have the primary trend, which is what we often think of as a market cycle. And finally, the secondary trend. That's the short-term noise within the bigger cycle. The whole game of technical analysis is built on spotting these movements, drawing trend lines, finding support and resistance.
That sounds like a pretty elegant framework, almost like a map for the chaos. But
yeah,
there has to be a catch, right? A limitation that everyone needs to understand.
A huge one, and it's the most critical caveat, something you, the listener, have to get right from the start.
Okay.
The limitation is just baked into the process. A future market trend can only, and I mean only, be definitively determined in hindsight.
So all this analysis is backward-looking.
We have to be crystal clear on this. Market timing, predicting the future, it's a game of probabilities, it's educated guessing, it's not a crystal ball. Technical analysis lets us identify and characterize past trends with perfect clarity.
So the market trend is really the ghost of price action past. We can draw the lines perfectly on the history books.
It's exactly.
But looking forward, we're flying blind.
Precisely. When we say we've identified an uptrend, all we're doing is connecting a series of higher highs and higher lows on a chart that's already been printed. For a downtrend, it's lower lows and lower highs.
Right.
The problem, of course, is that in the present, those trend lines are constantly being challenged or broken or redrawn. The now always feels uncertain, which is why having this language secular primary secondary is so essential. It helps you frame where you are, even if it can't tell you where you're going tomorrow.
Since we are defining the language of markets, we have to start with the most famous animals in finance.
The bull and the bear.
The bull and the bear. Everyone knows a bull market means prices are going up, and a bear market means they're going down. But what's really fascinating here is the origin story. It's not what you'd expect.
No, it's one of the great anecdotes of financial history, and it shows you just how intertwined markets and, society were. These terms didn't come from some academic theory. They came from the rough-and-tumble world of London's Exchange Alley way back in the early 18th century.
Exchange Alley. So this is before a formal stock exchange even existed. This is the Wild West of trading.
The absolute Wild West. And let's talk about the bear first, because that term actually came before the bull.
Okay.
It came from a group of traders called bearskin jobbers. These were middlemen who were basically running a futures market for bearskins. But the key thing is they were doing what we would now call naked short selling.
Selling something you don't actually own yet.
Exactly that. They'd sign a contract to sell bearskins at a set price on a future date without having any skins. They were betting that the price of the skins would fall before they had to deliver, so they could buy them cheap and, pocket the difference.
So they were selling the bear skin before they'd actually caught the bear.
You've got it. That's the phrase. And that idea, that act of selling first and betting on a price drop, became synonymous with being a bear. A bear is pessimistic by nature. They're wagering on a decline.
That is such a vivid, perfect origin for short selling. So where does the bull come in?
The bull came a bit later, probably just as a natural opposite in conversation. The traders who got called bulls were the ones buying shares, often on credit, going long. They were optimistic.
And the names themselves were an analogy to the popular sports of the time.
That's the leading theory, yes. Think about it. Bear baiting and bull baiting were huge, if brutal, cultural events back then.
Right.
So the bull was put in opposition to the bear, not because of how it attacks, but because the two animals were famously paired against each other in the fighting pits. The terms just mirrored the two opposing sides in the market.
And we actually have a record of this from the time, don't we? A description of what these traders were like?
We do, and it's fantastic. A guy named Thomas Mortimer, in his 1761 book, Every Man His Own Broker, he wrote it all down. He gives us this amazing window into the psychology.
What did he say?
He described the bulls, the ones who had bought too much, who were over-leveraged, wandering around the offices moaning, just desperate to find someone, anyone, to buy their shares.
So that moment of panic when your optimism turns sour.
Exactly. And then he described the bears, the short sellers, as rushing frantically around the alley, trying to buy up any shares they could find to close out their positions. He literally says they were devouring any shares they could find.
Wow.
It's the perfect contrast, right? The bull is suffering from too much greed, and the bear is suffering from intense fear.
That is so much richer than the simple story you always hear.
Oh, the folk etymology. Yeah, we should probably debunk that quickly.
The idea that a bear swipes his claws down and a bull thrusts its horns up?
That's the one. It's a charming story, but it's completely unrelated. The sources are clear. The real origin is in those 18th century market practices. It's a good reminder that, this jargon has a very human, very visceral history.
Okay, now that we have the language, let's get into the geography of market time. You talked about the ocean.
Yes. If you imagine the market as this huge ocean, you have to understand the tides, the waves, and the little ripples all at the same time. As we said, structure is key. And that means breaking it down into those three nested layers.
Let's start with the biggest one, the one that feels almost geological, the secular trend.
Secular trends are the really profound long-term movements. We're talking massive time frames, anywhere from 5 to 25 years, sometimes even longer.
Wow.
These are the mega trends. They're driven by huge structural shifts, demographic changes, massive new technologies. Think about the invention of the internet or the baby boomers entering the workforce. Those things create secular trends.
So if the market goes up for, say, 15 years, that's a secular bull market. But you said it's not just a straight line up.
That's the critical part to understand. A secular trend is defined by its net direction over that long period. So a secular bull market has this prevailing upward movement, but inside that 2-decade climb, you will absolutely have several multi-year primary bull markets, interrupted by some very painful primary bear markets. It's a long-term upward journey, but one that is constantly testing your resolve as an investor.
It sounds like the market rewards patience on a massive scale, but only if you can stomach some serious downturns along the way. Can you give us some solid examples?
Absolutely. The classic example of a secular bull in the U.S. is a period from about 1983 all the way to the year 2000.
The dot-com boom.
Right. And you could argue it extended to 2007 in some sectors. It was this long, powerful climb driven by falling interest rates, the rise of personal computing, globalization, and even with sharp shocks like Black Monday in 87, the overall direction just kept going up. Another great example was the commodities boom in the 2000s, driven almost entirely by the explosive growth in China.
And on the other side of the coin, the secular bear market.
Yeah.
That must be where investors just lose all hope over time.
It's a slow, grinding death for optimism. That's when the prevailing trend is down, and it's made up of these smaller, deceptive bull rallies that give you false hope.
Right.
And then much larger, more severe bear markets that crush that hope. The textbook case is the U.S. stock market from 1929 to 1949.
20 years.
20 years. After the Wall Street crash, the market was just brutalized by the Great Depression. The overall movement was just flat to negative for an entire generation.
That kind of experience must have scarred people for life financially.
It absolutely did. It created a decades-long bias towards safe assets like bonds. And another powerful example, just to show it's not only stocks, is gold. It had a massive secular bear market. It peaked at around $850 an ounce in January 1980, driven by inflation fears.
I remember that.
And then it just declined relentlessly for almost 20 years. It finally bottomed out in June 1999 at just $253 an ounce. That moment is famously known as the brown bottom. That's a 19-year downward spiral.
Okay, so zooming in from that 25-year view, we get to the primary trend. This is what people usually mean when they say market cycle, right?
That's exactly right.
Yeah.
A primary trend is that medium-term engine. It typically lasts for a year or more, maybe as long as 5 or 10 years in some cases. The key thing here is that the movement has to be broad. It can't just be one hot sector.
Yeah.
It has to have support across the entire market, reflecting the underlying health of the whole economy.
So this is the level that really drives most Investment decisions, retirement planning, all of that.
Precisely. It defines whether we're in a cyclical bull, which is a sustained rise, or a cyclical bear, a sustained decline. And the sum of all these primary trends is what creates that big secular trend we just talked about.
Which brings us to the final layer, the ripples on the surface, the short-term noise.
The secondary trends, these are the short-term changes in direction that happen inside a bigger primary trend. It could be a reaction to an earnings report, a geopolitical flare-up, a central bank comment.
Right.
They last a few weeks, maybe a couple of months. They are the definition of volatility.
And the lesson for an investor there seems to be, learn to ignore them. They're designed to shake you out, but they don't matter if the main primary trend is still intact.
That is the so what of it. A secondary trend is like a stress test. It shakes out the weak hands, the investors who panic easily before the primary trend can get going again. These little corrections and rallies are a necessary part of any big move, up or down.
Okay, let's focus now on those two major states of the primary trend, bull and the bear. We need to get into the precise technical rules here, because the line between a healthy market and a full-blown panic seems pretty thin.
And it is. Knowing the thresholds is crucial. But beyond the numbers, the most important thing is the huge psychological shift that defines these two periods. It's the difference between, optimism and utter despair ruling the day.
Let's start with the bull, a period of rising prices. But what's the technical trigger? When is a bull market officially declared?
The globally accepted definition is that a primary bull market officially begins when stocks rise 20% from their previous low.
20%.
That 20% surge from the bottom signals a really substantial, sustained shift in momentum. And conversely, the bull market is declared over when stocks fall by 20% from their peak.
So that 20% rule is the key. It's the line in the sand. Now, the source material had a really interesting little nuance here, saying a bull market might not be a true bull market if it's happening inside a huge secular bear. Can you explain that?
Yeah, that's a more advanced but important point for analysts. Some strict cycle theorists would argue that a 20% rally is just that, a secular rally, if the long-term drivers, demographics, interest rates, if those are still negative.
I see.
In their view, a true primary bull needs all the big forces aligned. But for most everyday financial reporting, that 20% rule is the benchmark.
Okay, now, the psychology of this is fascinating. It's totally counterintuitive. The start of a bull market isn't happy. It's gloomy.
It is the ultimate contrarian signal. A bull market starts in widespread pessimism. It begins at the exact moment the crowd is most bearish, when fear and disgust are at their peak.
And then it evolves.
It evolves through these predictable stages. It goes from deep despondency to cautious hope, then to widespread optimism, and it finally ends in pure, unchecked euphoria right before the whole thing breaks.
And this psychological wave often happens before the real economy gets better. The market is like a leading indicator.
It is a leading indicator. It often starts its recovery while unemployment is still high and the economy is in recession. It shows you the market trades on future expectations, not the present reality. The so-called smart money gets in when the headlines are still awful.
The historical data on this is pretty incredible.
It's staggering. If you look at the data from, say, 1926 to 2014, the average duration of a bull market was 8.5 years.
8.5 years.
Think about that. And the reward for staying the course, the average cumulative return was an astonishing 458%.
458%. That's how generational wealth is built right there.
That's the engine. And the annualized gains were also huge, ranging from about 15% up to 34% a year. We're talking about periods like the post-war boom or the mid-90s tech revolution.
And this isn't just a U.S. or Western thing.
Not at all. A great global example is India's Sensex index. Between April 2003 and January 2008, it went on an epic bull run.
Right.
In that 5-year window, the index went from around 2,900 points to over 21,000. That's a return of over 600%. It just shows you the raw power a bull market can unleash.
Okay, now for the dark side, the bear market. This is that terrifying transition from euphoria into fear and panic.
It's a complete reversal of confidence, and technically it's defined as a general decline of 20% or more from the peak, lasting at least 2 months. That duration is important. It means it's not just a flash crash.
And we have to distinguish this from a correction.
Absolutely. A drop of 10% to just under 20% is a market correction. Corrections can feel scary, but they're generally seen as healthy. They shake out the speculation. A full primary bear market is that deeper, more sustained 20% drop.
And what about this idea of bear territory? That sounds like the phase where the danger is clear, but the official call hasn't been made yet.
That's a great way to put it. Bear territory is the prelude. It's when the market might still technically be in a correction, but all the warning lights are flashing red.
Like what?
You see the VIX, the fear index, just skyrocket. Consumer sentiment starts to plummet. Businesses get pessimistic. Unemployment expectations start rising. The whole economic outlook just sours fast.
And this can often be triggered by, say, policy uncertainty without getting into the politics of it.
Yes, the source material notes that major policy shifts, things like sudden tariff changes or unexpected interest rate moves, can absolutely push a market into bear territory. The key thing to know is that when a market enters bear territory, it very often leads to the full-blown bear market confirmation.
So how do we know when the pain is finally over?
Well, technically, a bear market is over when the market not only recovers, but makes a new all-time high. But the more common signal is, again, that 20% rule. When the indexes gain 20% or more from their absolute lowest point, the bear is considered to be over.
The 20% rule is the way in and the way out.
It's the gatekeeper. And look, bear markets are much shorter, but they are incredibly intense. The data from that same 1926 to 2014 period shows the average bear market lasted just 13 months.
Only 13 months.
But the average cumulative loss in that short time was a crushing 30%.
Wow. So in just over a year, you could lose a third of your portfolio. That speed explains the panic.
It really does. The annualized losses could be anywhere from nearly 20% to a gut-wrenching 47%. And the examples are burned into our financial memory, right? The 29 crash, which wiped out 89% of the Dow.
89%.
The long, grinding bear market of the 1970s with the energy crisis. And of course, the 2008 financial crisis and the more recent 2022 decline driven by inflation and rate hikes. They're incredibly destructive.
Okay, so we've defined the trends. Now we get to the really hard part. Trying to spot the turning points. This is what every investor dreams of doing, but almost nobody gets it right.
It's the impossible art of market analysis. These inflection points, the tops and the bottoms, they are only truly clear in hindsight. They're just fraught with peril.
Our sources say a market top usually isn't some big dramatic single-day event.
Yeah.
That feels wrong, given the chaos that comes after.
It is a bit counterintuitive, but it's one of the great lessons. The market just reaches its highest point for a while, but the recognition of that is almost entirely retrospective.
Why?
Because when the peak actually happens, the euphoria is usually still at a maximum. No one believes the party is over. Then prices start to drift down, sometimes slowly, sometimes very quickly.
Are there any technical signs that the smart money might use to get out before the crash really accelerates?
Yes. This is what technical analysis, especially the work of people like William O'Neill, comes in. Going back to the 1950s, he identified that a market top is often characterized by an accumulation of distribution days.
Distribution days. Okay, that's a key term. What is that?
A distribution day is a trading day where a major index, like the S&P 500, closes lower than the day before, but on higher trading volume.
Higher volume on a down day.
Exactly. The high volume suggests that big players, institutions, are actively selling or distributing their shares to the general public who are still enthusiastically buying the dip.
So the pros are quietly heading for the exits while the retail crowd is still rushing in.
That's the signal. It's a silent warning bell. The rule of thumb is that if you see 3 to 5 of these distribution days in a major index within a short period, it's a strong sign that a top is being formed. Institutional support is just evaporating.
Can you give an example?
Sure. The peak of the dot-com bubble, the Nasdaq 100, peaked on March 24, 2000. But in the weeks leading up to that, there were clear distribution days. The same thing happened before the 2008 crisis. The S&P 500 peaked on October 9, 2007, again after a period of clear institutional selling.
Okay, so now the mirror image. The market bottom. This is the end of the downturn, the start of a new bull. It's the most profitable time to buy and also the most terrifying.
And trying to pinpoint that exact moment, what's called bottom picking, is famously difficult. The danger is a false signal.
A false bottom.
Right. You buy in, the market bounces for a couple of days, you think you're a genius, and then it resumes its plunge, and you're stuck with even bigger losses.
This is where that famous contrarian quote comes in.
Baron Rothschild. The wisdom is that the best time to buy is when there's blood in the streets. Meaning you buy not just when prices are low, but when sentiment is at its absolute worst. When there is panic, when there is fear everywhere, you're buying the fear, not the valuation.
And the history of market bottoms really backs that up.
It does. Think of Black Monday in 1987. The Dow bottomed out after a historic one-day crash. That was pure fear. Or the bottom after the dot-com bust in October 2002. The tech-heavy NASDAQ fell almost 79% from its peak.
79%? That's just a wipeout.
It's a total wipeout. It shows what happens when a real bubble bursts. And more recently, the bottom after the 2008 crisis was in March 2009. In all these cases, the bottom was only clear once that 20% rebound started and actually held, confirming that the fear had finally burned itself out.
Now, before we move on, we have to talk about the most deceptive trap of all, the false signal that tricks people into getting back in too early.
Yes, the bear market rally. This is a short-term price jump of, say, 5% or more that happens before prices start falling again. It is an incredibly dangerous trap for investors.
It sounds kind of harmless, but the other names for it are a lot more vivid.
They definitely capture the pain. It's often called a sucker's rally, or the most famous one, the dead cat bounce.
Right.
The grim logic being that even a dead cat will bounce if you drop it from a great enough height.
A dark but very clear analogy for a market that has a brief recovery before plunging even further.
We saw them all the time during the Great Depression. After the 29 crash, there were several rallies of more than 10% that sucked investors back in, right before the market collapsed toward its true bottom in 32.
Mm-hmm.
Another classic case is Japan's Nikkei 225 index. Throughout its long two-decade downturn from the late 80s, it had numerous powerful, sharp rallies that all ultimately failed. This is why bottom picking is so risky. These rallies look and feel like the real thing.
Okay, here's where it gets really interesting for me. We've mapped the what and the when. Now let's get to the why. We're moving beyond the charts and into the human element, right? Supply and demand.
This is the critical pivot. At the end of the day, prices don't move because of lines on a chart. They move because of human decisions. If you can understand the behavior, you can understand the trend.
Let's start with the basic mechanics. The price of anything is set by supply and demand. But there's a huge myth here we need to bust right away.
Yes. You always hear it on the news. The market went up today because there were more buyers than sellers.
Right.
That statement is mathematically impossible. By definition, the market always balances. For every single transaction, there has to be one buyer and one seller.
So if the number of buyers always equals the number of sellers, how does the price ever move?
It's not about the number of people. It's about the intensity of their desire. Think of it like an auction. You have a line of sellers with their asking prices and a line of buyers with their bidding prices.
Okay.
When demand surges, it means the buyers get aggressive. They're willing to pay the higher asking prices of the sellers. That's what moves the price up. When supply surges, the sellers get desperate and they're willing to accept the lower bids from the buyers. That moves the price down.
So it's not the quantity of people, it's the aggression of their bids and offers. It's about who's more motivated.
Exactly. And this is constantly being affected by big money moving around. Imagine a huge pension fund decides to sell government bonds and buy tech stocks. They are simultaneously creating a huge supply of bonds and a huge demand for stocks. That single act pushes the price of bonds down and the price of tech stocks up.
Which brings us to the core of investor behavior. Ideally, everyone wants to buy low and sell high. But in reality, driven by emotion, people do the exact opposite.
They buy high, near the top, driven by greed and FOMO, fear of missing out, and they sell low, near the bottom, driven by pure panic.
And this is why the contrarian strategy even exists.
It's the whole basis for it. Contrarian investors try to fade that emotional herd behavior. They are buying when everyone else is terrified and selling.
That's what's called the accumulation phase.
Correct. And they are selling or distributing their shares when the euphoric crowd is clamoring to buy at the top.
And this leads to a really critical idea from behavioral economics, how this herding instinct actually breaks the normal rules of supply and demand.
Yes. Standard economic theory assumes what's called a negative feedback loop. If a price goes down, demand should go up because it's a bargain, and supply should go down because nobody wants to sell cheap. This stabilizes prices. But in the stock market, that often gets flipped on its head. A price increase can lead to an increase in demand. That's the euphoria, everyone piling in. And a price decrease can lead to an increase in supply. That's the panic selling.
So that's the mechanism that creates bubbles and crashes.
It is the mechanism. When that negative feedback loop breaks, the system becomes unstable. It feeds on its own momentum, its own emotion, until it finally exhausts itself or just violently snaps. The economist David Hirschleifer put it perfectly. He said trends move from investor underreaction to new information, and they end with massive overreaction.
So if emotion is the driver, how on earth do you measure it? How do you measure the mood of millions of people?
You use proxies. You look for data that quantifies the behavior of the herd. And market sentiment is an incredibly powerful contrarian indicator, especially at the extremes.
So when everyone is terrified, the blood in the streets, that's a buy signal.
That's the theory. When an extremely high percentage of investors are bearish, it's a strong sign that a market bottom is probably close. And there are several tools we use to track this.
What's the first one?
The Investor Intelligence Sentiment Index. This looks at professional newsletter writers, and it measures the spread between the bulls and the bears. When that spread hits a historic low, meaning basically all the pros are pessimistic, it's a very strong signal of a potential bottom. It quantifies the exhaustion of selling.
That's so interesting. And you mentioned it's more reliable at bottoms than at tops.
Yeah.
Why is that?
It's about the nature of fear versus greed. Fear is a powerful, sudden emotion. It leads to quick, sharp bottoms when everyone panics at once. Greed, on the other hand, is a slow burn. Euphoria can last way longer than you think is rational, so it's much harder to time the top.
Okay, what's another indicator?
The AAI Sentiment Indicator. This tracks individual or retail investors. When that reading is, say, minus 15% or lower, it means a huge majority of individuals are negative. And that often means most of the decline has already happened. The retail investor is usually the last to capitulate.
It's a measure of when the general public has finally given up. Are there tools that track actual bets being made?
Yes, and those are very powerful. The put-call ratio is a big one. A put option is a bet the market will fall. A call option is a bet it will rise.
Right.
So a very high put-call ratio means traders are overwhelmingly betting on a decline. Paradoxically, that's often a bullish signal because it means bearishness is at an extreme. There's nobody left to sell.
I see.
And other things like the short interest ratio. That measures how many shares are being sold short. If that number is extremely high, it means there's a huge pool of future buyers because all those shorts eventually have to buy back the shares to close their positions, and that creates upward pressure. They all try to quantify the extremes of fear and greed.
So to pull this all together, to synthesize the takeaways from this deep dive, market movements are predictable, but only in their structure.
Exactly. We know price action unfolds in these layers. The long secular trend, the medium primary trend, and the short secondary trends. That part is predictable. But the timing, the velocity of those moves, that's driven by crowd psychology, which consistently works against the average person's best interests.
And the numbers give us the guardrails. We know a bear market is that 20% decline. A correction is less than that. We know the average bull run is long and powerful over 8 years, while the average bear market is short and brutal, about 13 months.
And that cycle of accumulation, buying in fear, and distribution, selling into euphoria is just constant.
That psychological cycle is what makes it so hard. We're always fighting that urge to follow the herd, the instinct that causes the bubbles and the crashes in the first place.
It's the fundamental challenge.
So what does this all mean for the person trying to be, disciplined and well-informed?
It means the data can tell you about the structure and the potential severity, how long a downturn might last, how much you could lose, but it's your handle on psychology that will determine your timing and ultimately your success.
And that leads to one final provocative thought. The material is crystal clear. We know a bull market ends in widespread euphoria. We also know the technical trigger for a bear market is that 20% drop from the peak. The challenge is this. If we are truly rational investors, we should be selling aggressively during that euphoria well before that 20% drop confirms the damage. But can the rational discipline of technical analysis ever really overcome that fundamental human need to ride the wave, to chase that incredible 458% average return right to the very end? The real deep dive perhaps isn't into the charts at all, but into controlling your own behavior. And that's something for you to mull over until our next deep dive.